My name is Jhenna Broussard, and I am in the Fundamentals of Business Analysis class. I will be conducting a brief today on sensitivity analysis in capital budgeting. The agenda for today will cover the purpose, define the capital budgeting, define sensitivity analysis, qualitative and quantitative steps for sensitivity analysis, project risk incorporation into capital budgeting analysis, the summary, and the references. This class is on how to conduct a sensitivity analysis as a tool for capital budgeting. What is capital budgeting? Capital budgeting is the process businesses use to evaluate whether to fund major projects or investments intended to increase cash flow or advance strategic objectives. Or in other words, the goal of capital budgeting is to determine whether a business project is worth pursuing financially. In the matter of business, there are 5 major methods for valuing investment projects. 1. The payback period, the amount of time in years required to recover the initial costs of the project selected. 2. The discounted payback period. This is the amount of time in years required to recover the initial cost after paying the investors their required returns. 3. The net present value. This is the most preferred method to use, and it's based off the calculation of the present value of the stream of cash flows the project is expected to produce over its economic life, discounted at the product's cost of capital, then summing up the present values of the stream of cash flows, including the initial cost. 4. The internal rate of return, the discount rate that forces the net present value of cash flows to equal 0, or in other words, the yield to maturity of cash flow streams. And finally, the modified rate of return, which is equal to the internal rate of return with the exception of changing of the reinvestment rate assumption, or in other words, reinvestment of cash flows. So what is a sensitivity analysis? There are many definitions for sensitivity analysis, everything from helping you to calculate the importance of a particular assumption or set of assumptions, showing the magnitude of changes in outcome, or the study of how outputs of a system are related to and influenced by its inputs, looking inside of a system to decompose the variability in the output to tell us what portion of it comes from what input, or the process of estimating how target variables change in relation to the changes in input variables. I think one of the best definitions are listed above, which is a quantitative technique looking at the range of sensitivity to different risks. One of the ways to evaluate this is using a sensitivity analysis tornado diagram, which you can see above. What's the commonality with all of the definitions that I listed? It's a basic measurement of risk, commonly referred to as a risk assessment. In the tornado diagram that you see listed, the risk associated has the broadest range of impact sitting at the top, trending all the way down to the bottom with the narrowest range of impact. In relation to capital budgeting, a sensitivity analysis evaluates projects that a business is considering undertaking to measure what projects pose the highest and the lowest associated risks. So why do a sensitivity analysis? Well, the capital budgeting methods we covered involve calculations used to determine certain financial estimates of where a project may or may not essentially lead a business in growth. But that doesn't mean that these calculations are accurate. This is what a sensitivity analysis will provide for because it changes the assumptions or estimates in a calculation to see the impact of the project's finances to prepare the management team for expected or unexpected results. This gives them better judgment towards selecting a project. So how do we conduct a sensitivity analysis now that we know it is a tool for capital budgeting? In the case of a business, we would probably look at completing an essay on a business case, which is a set of assumptions, or in this case, a portfolio of projects about your business activity that you might undertake to grow profitability with invested money. The steps listed are create a business case portfolio, undertake a review of what drivers affect cost and benefits for the projects the company is considering, take those costs and benefits and conduct a market analysis to add numerical value to them, manage these scenarios in a form of comparison, i.e. a tornado diagram, or identify the most significant assumptions that affects the output. An example of this is listed in front of you. What you can see provided are different variables being analyzed, comparisons of high and low impacts, risk probabilities, and costs associated. Evaluating this one project out of a business portfolio, we can see that all the risks associated with this particular selection and the impacts it may bring forth. Notice that the impact listed at the bottom of the chart and at the top of the tornado diagram indicate the knowledge during the testing phase, which is the most significant variable. Also, one thing to keep in mind in sensitivity analysis for capital budgeting are the following themes: cost of capital, cost of debt, and cost of equity. You can somewhat see all three reflected here in the diagram. Resistant stakeholders reflect the cost of capital, resources unavailable speaks to cost of debt, and technical services disrupt failure speaks to cost of equity. This tornado diagram is just one way to conduct a sensitivity analysis as a financial manager. You can utilize whatever tool you find most comfortable, such as the waterfall diagram. Capital budgeting risk incorporation. Earlier, we defined what capital budgeting looks like, going over the 5 major methods: net present value, payback period, discounted payback period, internal rate of return, and modified rate of return. Valuation and calculation using these methods is a way of incorporating risk analysis into a business who wants to decide about what fixed assets to invest in to minimize shareholder profits. Risk incorporation is important in capital budgeting because this aids in the building blocks of the significant decision making within a company, which can add to a company's value, allow them to remain competitive in the market, provides opportunity costs for reinvestment, and creates long-term impacts on the company. In summary, today we've defined sensitivity analysis and capital budgeting, described the quantitative and qualitative steps to conduct a sensitivity analysis, and provided an example of what a sensitivity analysis looks like. These are my references. Thank you very much for your time.